Welcome to this explainer. Have you ever felt like the economy is just this massive multiplayer game that literally everyone is playing, but nobody ever bothered to hand you the instruction manual? Well, today we're going to fix that. We are going to break down the complex, invisible forces of money and the economy by looking at them exactly through that lens, as a video game. We'll decode the rules, figure out how the mechanics actually work, and ultimately show you how to play to win.
Here's our playbook for today. We're looking at Level 1, the cost of civilization, Level 2, how banks actually work, Level 3, invisible economic forces, Level 4, your financial trust score, and finally, Level 5, cheat codes for wealth. Let's dive right in.
All right, Level 1, the cost of civilization. Think of this as your base server fee just to log in and play the game.
Think about this for a second. Currency isn't actually real. I know, it sounds crazy, but humans developed money simply to organize society and make trading easier. Physically speaking, a dollar bill has no more inherent legitimacy than a random stick you'd find on the ground. It only works because we, as a collective society, share a belief and trust that it has value. The government prints it, central banks regulate it so we don't get some wild hyperinflation that turns our cash into monopoly money, and we trade it. That shared belief, that is the foundational game mechanic of our entire system.
And, because we all share this server, we have to pay for the upkeep. Whether it hits your income, your spending, or your investments, these tax deductions aren't just government penalties. They're the literal cost of civilization. Sure, doing your taxes can totally feel like a dangerous guessing game with the IRS, but that money is funding everything from the roads you drive on to ensuring your absolute favorite taco truck is actually up to health codes.
Which brings us right to Level 2, how banks actually work.
So your bank isn't some giant vault guarded by a dragon. Through a system called fractional reserve banking, the moment your cash hits your account, it's actually already gone. Banks are basically just middlemen. When you deposit $1,000, they immediately take $900 of it to lend to someone else who wants to go buy a jet ski. They rely entirely on the statistical probability that the entire player base won't log in on the exact same day to withdraw all their money at once.
Of course, if everyone does show up at once, the system completely crumbles, which is exactly what we saw in the 2008 crash. But we tolerate the risks of this fractional system because of one absolutely crucial mechanic: government insurance. Knowing your deposits are backed up to $250,000 serves as the ultimate panic button blocker. It's the psychological safety net that keeps the whole game from just unraveling.
Okay, moving on to Level 3, the invisible economic forces. These are the background mechanics constantly pushing your stats around. Let's talk about interest, because it has a brutal dual nature. It's essentially money charging rent to exist in someone else's hands. If you borrow money, interest is the price tag. If you miss a 20% credit card payment, that interest starts earning its own interest. And suddenly, a $12 burrito quickly turns into a $50 regret. It's a slow-burning time bomb. On the flip side, though, earning interest through investing is like giving your money clones. It literally duplicates itself, becoming your best unpaid employee. The choice is simply in who is collecting that rent.
Then we have inflation. This is the slow, quiet erosion of your money's value. It's the game's currency constantly being diluted. And what actually causes it? Well, it's often a combination of macroeconomic factors. You've got complex supply chain hiccups making manufacturing more expensive, or shifts in global liquidity. And sometimes, it's driven purely by consumer psychology and self-fulfilling expectations. If people anticipate prices rising, they aggressively buy assets now, which, ironically, accelerates that exact price increase.
Now, a little bit of predictable inflation is actually the game's optimal frame rate. Hitting right around 2% keeps the economy moving forward without overheating the system. But when inflation spikes and your savings start dying while your wages lag behind, central banks have to step in. They fight high inflation by raising interest rates, making capital much more expensive to borrow. This deliberately suppresses demand to cool off that overheated economy.
But sometimes, cooling off the economy leads to a recession. Think of the economy like a booming party. Everyone's dancing, capital is flowing easily, but eventually, the lights flicker, reality hits, people check their bank accounts, and suddenly the DJ starts playing sad lo-fi beats about corporate downsizing. Jobs vanish, companies aggressively cut costs, and spending tightens. Recessions are painful, absolutely, but they serve as a necessary system reboot before sustainable growth can eventually resume.
Next up is Level 4, your financial trust score. This is the game's ultimate unavoidable scorecard.
This shadowy algorithm knows your name, your past, and exactly how many times you paid your credit card late in college. Ranging from 300 to 850, this three-digit number decides if you get a house, a car, or a soul-crushing 27% interest rate on a personal loan. Now, what's really important to grasp here is that this number isn't about your wealth at all. It's strictly about your trust. Lenders just want to know your behavioral risk profile. Landing below 580 makes you a walking red flag to them, while scoring over 750 means you are just sparkling with adult credibility.
So, how do you optimize this level? Honestly, you don't need to overcomplicate it. Lenders use a specific set of rules to calculate your score, weighing things like your payment consistency, how much of your available limits you actually use, and the longevity of your accounts. It acts exactly like an in-game reputation stat. Neglect your payment history or constantly max out your limits, and it tanks your gameplay options entirely. But cultivate it diligently, and it effortlessly unlocks the best gear and the lowest borrowing costs down the line.
Finally, we reach level 5, cheat codes for wealth. You know the rules, you know the board, now we unlock the master strategies.
You absolutely cannot win the game if you leave your money sitting idle, because the final boss, inflation, will quietly steal your future. You have to deploy your capital into investment vehicles. Whether you prefer the equity of stocks, the fixed income of bonds, diversified funds, or leveraged real estate, the core mechanism is exactly the same. Deploying capital through these vehicles is how you stop trading your finite time for money and start trading money for more money.
To really accelerate your wealth generation, you need to master the concept of perceived value. Look at an average rock versus a piece of gold. Gold isn't inherently more useful for survival than a regular stone. It's just rarer, and humans collectively believe it matters. Creating massive wealth relies on this exact psychological manipulation of value. It is why tech founders earn billions and why luxury brands command 100 times premium over their actual utility. People perceive the brand, the product, or the service as immensely valuable, so it is. Provide massive perceived value, and the capital will follow.
But you know what? The ultimate cheat code isn't a hot stock pick or some disruptive startup idea. It's time. Almost everyone starts with a lot of it, but no one gets an unlimited supply. Wealth isn't built in days, it's built in decades. Capital sitting in an investment multiplies slowly at first, and then wildly faster as the math compounds upon itself. If you give compounding growth 30 years to do its thing, you will wake up one day to find that ordinary modest paychecks have turned into a massive portfolio. You'll realize you didn't beat the system, you just let the system's math work for you. It's true that you have to pay the server fees of taxes, and you have to navigate those invisible forces of inflation and recessions. But by using the banks, optimizing your trust score, and letting time compound your investments, you take the power back. Thank you for joining this explainer. The financial game might be rigged, but now that you know the rules, how will you rig it back in your favor?